In the next 5 minutes, you'll learn a bullish strategy that requires little capital but can yield high returns. Welcome to the world of sell-put vertical options. This strategy is like a skilled tightrope walker, perfectly balanced on the rope of the bull market. Here's how it works. You sell a put option and simultaneously buy another put option at a lower strike price. This creates a spread with limited loss potential and allows you to make money as long as the market price stays above the strike price of the sold put option at expiry. Let's imagine a tightrope walker named Betty. Betty bets that she can cross the rope without falling. If she makes it, she wins the bet. If she falls, her safety net, the bought put option, limits her loss. This strategy sounds simple, but it requires careful analysis and timing. It's like walking a tightrope. You need balance, precision, and a clear focus on the end goal. Now, let's dive into the risk and reward of this strategy. Imagine selling a put vertical option as a 3-part dance with the bull market. First, you're in the money when the market price at expiry is greater than both your sell put and buy put strike prices. It's like hitting a home run in a baseball game. You've made money on a bull market with minimal capital investment. Second, the dance takes a twist when the market price drops below the sell put strike price but stays above the buy put strike price at expiry. It's like stepping on your dance partner's toes. The buy put can't cover for you, the sell put gets exercised, and you have to buy over the stock. Third, you're in the max loss zone if the market price drops below the buy put strike price at expiry. It's like tripping and falling flat on your face in the middle of the dance floor. If you don't have enough money to cover, the broker can close your position or issue a margin call. Speaking of margin calls, it's like the DJ stopping the music and announcing you've run out of dance moves. It's a dreaded scenario where traders lose money. Remember, high implied volatility is like dancing to a fast-tempo song. There's more risk in keeping up with the beat, but also more reward if you can pull it off. In contrast, low volatility is like a slow dance. There's less risk of tripping, but the reward isn't as satisfying. Now that we know about the risks, how do we calculate our returns? Well, it's quite simple, really. When you sell a put vertical, you're essentially betting on the market price being greater than the selling put and buying put strike price on the expiry. The returns on capital are calculated based on buying power for options. That's the amount of cash you have available to buy options. Let's take a hypothetical scenario. Say you have $10,000 to spend, and you use $2,000 to sell a put vertical. If, at expiry, you make a profit of $200, your return on capital is 10%. The best time to employ this strategy is when the market is at a support level or right after the market turns bullish after a bearish phase. Picture this. A bear market is like a harsh winter. It's cold, gloomy, and not a lot of activity going on. But as soon as winter ends and spring sets in, everything comes back to life. That's similar to a bear market transitioning to a bull market. That's your spring, and that's when you want to get in with this strategy. But remember, if you try to sell put vertical in a bear market, you're essentially trying to plant seeds in the winter. Not the best idea, right? You're taking on more risk and could end up in the max loss zone. The best approach to sell put vertical is to find a strong stock that's relatively affordable and trade with a smaller spread between the sell put and the buy put. So choose your stocks wisely and time your trades well. Options trading can be a powerful tool in your investment arsenal if used correctly. It's not just about buying and selling stocks, it's about leveraging the market, using minimal capital to potentially reap substantial rewards. It's about strategy and understanding the nuances of the market. It's about knowing when to strike, when to hold back, and when to take calculated risks. And it's about learning to navigate the unpredictable waves of the market with skill and confidence. While options trading may seem complex, it's a skill that can be mastered with the right guidance and resources. It's about learning the ropes, understanding the mechanics, and fine-tuning your strategy. To learn more about options trading, visit bullbearvector.com. With their premium features, you can save time and reduce costly mistakes. Remember, options trading can help you make a lot of money if you know how to do it correctly. So, start learning today.